In the short runs, stocks are a voting machine. In the long run, stocks are a weighing machine. When stocks are overpriced, management would rather issue shares than take on debt. So that's why they take a long-term approach. AMD is up 84% year to date. It's one of the chip manufacturers that is surging, but it still has not reached its all-time high, and their history is quite interesting, and we're going to go through it, understand the fundamentals of the business, and take a look at how this stock has performed over the last 25 years, and perhaps why. All right, so we're Everything Money. We're value investors. We like to find situations in which the price of an asset is selling below its intrinsic value. What's intrinsic value? It's basically the long-term value of the business when factoring in long-term fundamentals, not month to month, not week to week, not day to day, none of that garbage BS in the media. We're here focused on the long-term fundamentals of a business because we believe in the short runs, stocks are a voting machine. In the long run, stocks are a weighing machine. So we're going to go over some basic fundamentals, and we're also going to get further into the company looking at analyst estimates, our 8-pillar analysis, and then finally, we're going to look at our stock analyzer tool, which is the most popular part of our software, which will allow us to make assumptions about the future on AMD and tell us what price we need to pay today to get an ample return on that money. It is very, very important that no matter how wide your range of knowledge on investing is, there is something in this video for everyone. So make sure you watch the whole video from beginning to end. Don't skip parts. It'll be very useful, even if you're advanced, to reiterate the positive things in your mind. So let's check out AMD in our software right now. All right, so this is our software, and this is AMD. Guys, check this out. Look how crazy this up and down is. Keep in mind here, AMD, before 2020, it never reached its previous high from 2000. Look at that. It tried in 2006, didn't hit it, fell all the way down. So back here in 2000, roughly its high was $50 maybe on the high side, not even. And then in 2006, it tried again north of 40. Got as low, guys, as $1.80, $1.70 maybe, $2.20, and then skyrocketed to an all-time high of $164 back on November 30th, 2021. And it's currently at 118, hitting a low less than a year after its high of $55 per share. Guys, remember this. I want you to see this and remember that in the short run, stocks are a voting machine. In the long run, they're a weighing machine. When you were overpaying here back in 2000, I want you guys to see the difference. Let's go to the income statement because this is something very important that all experienced investors need to repeat to themselves over and over, and all new investors need to understand when you're learning a process. This last year, the last 12 months, AMD did $23 billion in revenue. $23 billion. Now, remember, in 2020, it was the last time it hit its previous 2000 high. In 2020, they did $7.25 billion in revenue. It has tripled since then. Incredible. $7.25 billion in revenue. Let's go back to 2000 when it hit its previous high, $3.32 billion. So look at that. And all along the way, it got as low as $1.80 per share back in, what was that, 2015? 2015. Let's go back to the chart here to check it out. Yep, 2015. And let's see what it was doing in revenue in 2015. In 2015, it did $5.15 billion in revenue. So the stock had hit a high of around 50 in 2000, okay? And then in 2015, it was $1.80. Even though revenue, 15 years later, it had fallen 90, what is that, 97, 98, 96%. And in 2000, it did $3.2 billion in revenue, and here it did $5.15 in revenue. So an increase in revenue and the stock fell that much. Why? In the short run, stocks are a voting machine. In the long run, they're a weighing machine. It was an extremely popular stock back in 2000. Extreme. Look at this parabolic rise. You see that lately in a few other things. Just keep that in mind. Look at this parabolic rise recently since 2020. That's something I want you guys to remember. Just watch these things. These are very, very hard to sustain. All right. Two bear cases for AMD. One, issued a lot of shares recently for options. Guys, that's diluting people. What that means is if you own AMD stock, they're giving you more and more partners that they're splitting up your share of the revenue and profit. So let's say, for example, there are 10 investors in a business and you're one of them. And the main person says, you know what? I want to bring on 2 more investors. Well, they issue 2 more shares. So now instead of 10 partners, there are 12 partners. Before, you owned 1 out of 10 shares. That's 10%. But now when they added those 2 partners for you, your share went from 1 out of 10 to 1 out of 12. So instead of getting 12% of the business, you get instead of getting 10% of the business, you now get 8.33% of the business. And this is a very big problem with overpriced stocks. They want to issue shares and take advantage of that overpriced market. Let's look at the history right here of AMD shares. 10 years ago, they had 761 million shares outstanding. Today, 1.6 billion. So if you own shares 10 years ago, you have over twice as many partners as you do today. Over twice as many. That means if the exact example before of 10 shares now went to basically 22 shares, 23 shares. So instead of having you amongst 10 people, now it's you versus 23 people. You were getting 10% before, now you're getting 4 to 5% of the profit before. This hurts long-term investors. You don't want, they're diluting you. Now, it might make sense economically because the price is just nosebleed. But remember, guys, they were doing this back in when the stock was $1.80, $2. They were issuing shares. They were issuing cheap shares to investors. That's not smart capital allocation. That's terrible, actually. Another bear is the chip industry is currently going through a real problem with dropping demand, dropping revenue. Obviously, they saw a surge back in COVID, but long-term, one of the bull cases is the chip industry is a fast-growing industry. I've read reports that say there's going to be 12% compounded annual growth in the chip industry for the next 10 years. That's a lot of growth, guys. That's a ton of growth. And AMD makes a really, really great processor. Okay, they make a really, really great chip. I have a computer with AMD. I have a computer with Intel. They both do very well, but AMD has always been nipping at the heels of Intel with a very, very powerful chip. The stock price has been very, very erratic, though. That's been the scary part for AMD. Now let's take a look at the 8 pillars, and I'll try to explain some of these in a simple form. So this is our 8-pillar process. There's 5 green check marks here and 3 X's. So the first big ones are the 5-year PE ratio and the 5-year price to free cash flow are very, very high. What this does is it takes the last 5 years of earnings, averages it out, and the last 5 years of free cash flow averages it out, and takes the market cap and divides it into that. It's essentially taking a longer term look at the PE ratio and the price to free cash flow ratio. Because in any given year, those can fluctuate for a lot of different reasons. So that's why they take a long-term approach. But these are still selling for over 5 times my required amount. Does that mean it's overpriced? Not necessarily. There could be a great story as to why that is. But usually that's the case. There's a big difference between these two. But in this situation, they're very close. Now, the other thing I talked about before, in the last 5 years, shares outstanding have increased 66%. And earlier in the video, I showed you in the last 10 years, it's over 100% issuing of shares. I hate that. To me, that's not a management team that's trying to look after me as the investor. And that is something to consider. Now, does that mean they're always going to issue shares? Not necessarily. But you've got to remember that when stocks are overpriced, management would rather issue shares than take on debt. Because if they issue overpriced shares, they're not losing anything. They're just sitting there saying, hey, we want to raise all this money. We'll give you overpriced shares. You give us the cash. We're good with that. If they take on debt, though, if the stock price collapses, they still owe that big debt amount. Same with buying shares back. It's not good to buy overpriced shares back. You want to do the opposite when it comes to issuing shares. You want to buy back cheap shares, sorry. I don't blame AMD for doing this. I really don't blame them, but you have to realize this when I don't like the fact they're issuing shares even the stock was $2 a share, $3 a share, $4 a share. That really does bother me. Now, another big bull case for AMD is the big market growth in graphic cards chips. We're talking about 10x growth between now and 2032 as the potential. These are what analysts are saying. Who knows if that actually happens or not, but stronger and stronger chips will be needed as time goes forward, especially with this AI boom happening that will require more and more processing. And if you look back at history, the more and more processing we can do, the better our technology becomes. The more intricate our technology can be and the more powerful it always is. So just keep that in mind going forward. There's a lot of chip manufacturers out there, but the biggest ones will probably do the best with this kind of growth. Another bull case is AMD provides all the chips for the Sony PlayStation and the Microsoft Xbox. And those are really two strong gaming consoles that keep growing. Now the question becomes, my question is, are we always going to have consoles, or is it going to be based on the computer? You're just going to have some sort of digital version. That's the question to ask. A multi-bagger is a company that's gone up several times. A 10-bagger would be 10x, a 100-bagger would be 100x. We have read a book recently about finding multi-baggers, and a lot of great value investors will tell you that the best way to do well in investing is to find great companies that can grow and become those huge multi-baggers. So how do you find them? Well, join us for our webinar next Wednesday, June 14th at 1 p.m. Eastern Time. We're going to go over this entire process on how to find appropriate multi-baggers and how to take advantage of them. You won't want to miss this. Come check it out next Wednesday. Sign up at the link below next Wednesday, June 14th, 1 p.m. See you there. Now, to go back to a few more basics, market cap is 191 billion. Okay. They did 23 billion in revenue. That's a price to sales ratio of 8.26. The price to sales ratio takes the market cap divided by the revenue. Now, let's go look at a company like Intel. Now, Intel has its issues, but look at its price to sales ratio, 2.2. Market cap lower than AMD, revenue over double. Okay, let's look at NVIDIA. NVIDIA, 38 times price to sales ratio. That's a big number, guys. So it feels like things are frothy in the world of chips, but who knows? This could be the start of something big. But this does scream to me a little bit bubblish. Look at this profit margin, from 11.1% in the last 5 years to 1.7% in the last year. A current PE of 482, 5-year PE of 128. Oh boy. Now, market cap is 190 billion, as I said. That involves buying every share outstanding in the market at current market price. Right here is the enterprise value. The difference here is basically the debt and cash netted together and adding on to the market cap. So if you wanted to buy the entire company free and clear of all debt and no cash in the accounts, you'd pay $197 billion. I like the fact these numbers are very close to each other. It means there's not a lot of debt in the company. And for a company like this, I want to make sure they can stay in the game, because a lot of fast-growing companies will get into trouble by issuing a lot of debt, getting a lot of debt. And then if things go south in the business for a while, what's going to happen? And I want you guys to see this. This is the income statement. Look at the revenue quarter to quarter. Same quarter. This last quarter, they did 5.35 billion in revenue. The same quarter last year, 5.89. That's a big drop, okay? We might be seeing a slowdown in the chip industry for right now, and that's okay, because I want you, in our stock analyzer tool that we're going to do up here, I want you to remember that that's the important part of understanding the long-term value of a business, looking at the long-term fundamentals. Don't worry about the quarter-to-quarter, year-to-year results. Make sure they keep hitting what's important to the business. The market's going to do what it's going to do. If you believe in the chip industry long-term, the goal is to buy good companies at great prices, and you can absolutely do great companies at great prices. You can absolutely do that. The difference is, a great price for a great company is probably going to be a little bit closer to intrinsic value than a smaller company that has a lot of runway potential. All right. So what I mean by that is Coke at 18 times earnings is probably a lot better deal than some other company at 15 times earnings. Why? Because Coke's established. It's a great company. I think 18 PE on Coke is a great price for Coke. Same with Apple, same with Microsoft. Even though the multiple is higher than the market average, these are above average companies in the market with a lot of staying space, a high moat. Okay, that's the big key there. Now, one thing to show you guys is this return on invested capital is pretty low, 9%. The market average year to year is 9 to 10%. Now, it could be because fast-growing businesses, their return on the capital invested in the business can be swayed, because if you put a lot of money into sales and overhead to grow the business, it'll hurt this number going down. So I'm not as worried about this number being low. Okay. As a comparison, you know, like Apple is like 38% on this 5-year return on invested capital. So if you're new to the channel, this is going to be an important metric that you have to learn and understand. It's the return they get on the money they invest in the business. You can invest in the business through debt and through equity. It's the return you're getting on those two things combined. The higher it is, the better. The lower it is, they're actually destroying wealth, not creating wealth. Okay? We want them to get a higher ROIC to justify putting more and more money in the business. Look, some of our community tagged me in a chat. So let's check out what the analysts are saying about this company. They're expected to make $3.08 per share, growing to $7.75 in the next 4 years. That's a big jump. That's a big, big jump. And remember, analysts are just like you and I. In fact, they might be worse because they have career risks to worry about. They can't deviate too much. Look at these 41 analysts. Even though the range is pretty wide, I bet you the vast majority fall somewhere closer to $3.08. Okay? And as you get further and further down, the number of analysts following it go lower, but as the years go on, these numbers will catch back up. Now let's check out revenue estimates by the analysts. All right, not bad, but not as much as I would have thought. 23 billion this year, 24 billion, up to 38 billion in the next 4 years. Big time jumps, all right? Not doubling, but the earnings per share can double, more than double, because of a higher gross margin. The more gross margin there is, the higher the gross margin, the more they can send to the bottom line, the more money that's made to the bottom line, okay? Because that gross margin goes to pay overhead and income taxes, but overhead can stay the same as a company grows. They might only have to add more as they grow even bigger, not necessarily day one. Like if they sell 1 million more chips this year, do they need to increase their overhead? Maybe not. And that's what the big benefit of higher gross margin businesses are. So if this sounds confusing, again, we're here across the gamut of investors, beginners to the advanced. The key is to immerse yourself in this and listen to these things over and over. Rewind on this video more and more. Now, the next thing we have to do, and probably one of those popular, is use our stock analyzer tool. This was used 1.3 million times in our software by our users last year. And the reason being is every investment is the present value of all future cash flow. But we don't know what the future cash flow would be. That's why we use this tool. We make low, middle, and high assumptions for 10 years. Now you can do 1 to 20 years in the software, it doesn't really matter, but I believe in using the number of years of analysis based on how long you want to hold it, okay? Now, with this, the range of prices is going to be wide because you're doing a low, middle, and high. Your goal is to sit there and buy it when it makes sense, when the price is below what you determine the value to be. So for the software, for the stock analyzer tool, and all the other tools right here that we didn't even talk about, and for our community, we're running a special, $7, 7 days, $1 per day. Go to everythingmoney.com, sign up. You'll get everything you see here, and our price goes up every first of the month. So when you lock it in now, you lock in that price for the future at your level. So check it out right now, everythingmoney.com. So let's make some assumptions here. Okay, I'm going to do some aggressive assumptions. I'm going to do 6, 10, and 14% for 10 years. Profit margin, I'm going to do 8, 14, and 20. And the reason I went to 20 is, if you look at Intel, when they were humming, they were north of 20%. They were like 23 to 25% profit margin. AMD could do that as they grow. So I'm going to go to that 20% level and say, hey, listen, let's say they hit that day one and they really rock it. Free cash flow margin, I'm going to do the exact same thing because usually free cash flow and profit margin should be similar. If you see right here, though, it's actually always above, which is good. I like seeing that versus the other way around, okay? PE. Guys, don't be the Meet Kevin idiot who makes a PE assumption based on what the current PE is. At the end of the day, you should start at 15 in your head and say, okay, how do I adjust from here? There's a lot of growth potential in this company. They probably have a very diluted ROIC. So I'm going to start at 15 actually here. No, actually, I'm going to go a little bit different. I'm going to do 13, 17, and 21. Now, these are very wide ranges, very wide. This says at the end of 10 years, these are my 3 assumptions for the multiple they'll be selling at, okay? But we've seen that AMD has a hard time with their profitability and revenue and sustaining it. So I've got to account for that a little bit in these numbers here. Now for my desired return, again, because of the unknowns here and because of AMD being up and down all the time, I want to be a little more conservative. I can get 9 or 10% from investing in a long-term ETF. So what do I need in order to invest in an individual company? And on top of that, as you make your assumptions higher and higher, you need to make your desired return higher because this is your margin of safety. And it's less likely to hit this than this, which is less likely to hit than this. So the higher your assumptions, you need to give yourself a higher margin of safety. You can put whatever you want in there. I'm going to put in 12.5, 14.5, and 16.5. I'm going to hit the analyze button. Now make sure you watch this all the way through because we added an extra part to the software that's even better. It's going to tell you what return you would get on each of these assumptions if you paid today's price. So it's going to say, hey, if you paid today's price here and the low assumptions that happen, this is the return you'd get. The middle assumption happen, this is the return you'd get. So let's take a look. Guys, red all the way. 16 bucks, 38 bucks, and $72. This just tells me the stock is probably overpriced. It could be better, but if you paid today's price and the low side happened, you'd make a negative 11.45% IRR. If you paid the current price today and the middle assumptions happened, you basically break even, and the high side, you'd make 10%. So the question you have to ask yourself is, are any of these stock prices worth waiting for, or are you going to buy it today? And maybe they crush all these numbers. They could. They could beat all of these assumptions and do better than that. But if you do this in enough stocks, it'll probably work out the way it's supposed to. So guys, everythingmoney.com. I think you guys have seen for $1 a day, this makes all the sense in the world. Go sign up now, everythingmoney.com, and thank you very much for watching our channel.